Hi all. Today we see the difference between short straddle and short strangle. So previously we've seen about the long and long straddle and long strangle. Today we discuss in detail about this. So what is the before going into the graphs? So primarily, so what is the basic difference between these two strategies actually? So as we can see from the graph, so these strategies are predominantly used by option writers in collecting the premium upfront. So what does that it mean? So this option writers, they collect the premium when the stock price it is in the same place. It is not moving in either sides. They start collecting the premium. So as you can see in the graph on my right hand side, so say for example the stock is Apple, the spot price of the stock is $50, and we expect, so the markets are going to be range bound for a month or so. So what we are going to do is we are going to short both call and put option of 50 strike. So the basically means the short here is we are going to sell both the options naked. So the naked in the sense it's only one leg. So we're going to short both call and put options. So by shorting this put options, we will receive the premium of $20 from each of the options. So say for example, the call is trading at the call option of 50 is trading at 10. So since we short, we receive 10. The call option of put is trading at 10. Then we received the premium of 10. Put together, it amounts to 20. So what happens here is at the expiry, when the stock is at the same place, since we are the option writers, since the stock is at same place, we will collect this premium. So the option buyer, who is incurring the loss? The person who have bought this option has incurred the loss. So when as option writer, we are going to incur the losses. So since option selling, the profits are limited. As you can see here, our profits is maximum cap to $20. So our losses are unlimited. So the losses are unlimited in the sense, say for example, if the security price is 100, your losses are limited to $100 since the securities can't fall below 0. So that is the reason. So now we can see our negative territory once the stock move beyond 40 on the downside. Say for example, if the stock is at 35, so we'll be losing $5. If the stock is at 20, so we'll be losing $20. So the reason is most of the option writers predominantly use this strategy because at the money options usually trade at very high premium, because there is no intrinsic value, only time value in the options. That is the predominant factor. So and also the break even point, you can see since we have collected the option premium of 10 on the call and 10 on the put, so we have a cushion of $20 on the stock price. So only if the stock make a predominant move in either of this direction, we will be incurring losses. So that's the case. Now coming to the first graph, that is the short strangle. So there is a basic difference between those two. So as you can see from the graph, we are expecting the markets to be range bound, but we are expecting a wider zone. The reason we are taking this strategy is here we are risk averse. As a risk averse investor, we are going to short, we will choose the strike of both out of the money options. So we will short both out of the money put and out of the money call. Since these are out of the money, the premium of these options will be less. So since we collected less premium, so our profits is less. As you can see here, the profit for the maximum profit for short straddle is 20. Here it is somewhere around 10. So in the same way, here the point is that only if the stocks move predominantly on the downside, we'll be incurring losses. Say for example, if the stock is the stock is between $40 to $60, we are well and good. There is no loss on our strategy. We'll be still collecting $10. The stock falls below 40, say for example if it goes to 20, still we are in trouble and we need to pay the $20. So the reason why people do the short strangle is they have the cushion. You can see they have a range. Here it's a single point, here it's a range. You have a cushion between the range. So if the stock stays between, say for example, the stock's going to 50 to 60 and it is coming back to 50 and then it is going back to 40, still you are in a good position to collect this $10 premium. So in this case it's not that option anymore, because once the stocks fall to 30 you will be in panic mode and we need to square off the positions, because since this was short straddle, since we are in short positions, we need to bring the upfront margin, variation margin, to keep our positions live. So and also the basic difference between the long and short straddle is the margin amount. In case of the long positions, we would have paid only, say for example, if it's a long position, we would have paid only the $10 into some lot size if it's a call option. But if you want to buy the same options, if you want to sell the same option, it might be a 10 times or 20 times of the margin amount. Say for example, if we want to short the same option, we need to plug in somewhere around $2,000. You can see the difference. So we get $20 for $2,000 capital. Here the maximum investment is $100, but this investments can be added to zero. There is a possibility of since all we of us know, this can go to zero due to the time value factor. Since we are the buyer of the option, our profits are limited. Even though our profits are limited, we are in a position to lose our money. That is the thing. So now this is the one. So if you have any doubts, you can post on the comment. So keep watching. So I'll be coming up with more videos. Please post in comment your feedbacks. So I'll be improving myself on the coming sessions. Thank you.